Nick, thanks for coming again to support us. I remember just last week you fly down from Singapore. That's probably the 30th of Chinese New Year to Sydney, and then go back and come back again. Really appreciate your time.
No, thank you so much for having us. I mean, GloryHouse is in its new phase of growth, and we are more than happy to be a part of it.
So today we probably start from some of your personal story. How do you get into this industry? When do you start? When do you move to Hamilton Lane?
Yeah, no, it has been a relatively interesting start for me, or maybe in some ways almost boring. When I came out of university, I was always focused on real assets, and I came from a finance background, always something that was a bit more tangible. So I started my career really looking at data center investments across Asia Pacific. And it's a great time when you're thinking about how you can source the best land, making sure that you've got power and it's all connected. As you know, AI and data centers are the hot topic today. And so based off that backdrop, I then joined Hamilton 4 years ago, where I came in to lead the start of our Asia Pacific infrastructure business. And it's just been onward and upwards from there on out. Obviously, infrastructure is a really hot asset class today. There's a lot of benefits to global portfolios, and for myself to be able to be part of it and the broader Hamilton Lane platform with over 34 years of private market investing has just been a wonderful journey today.
It just like you said, when you start from one sector, infrastructure tend to be a boring industry, and now it's become a very hot industry. Everybody want to get involved. So when you were starting this sector, how do you sort of balance when you see other people in a more exciting sector?
Yeah, no, I think that's a great question, because when you think about when you first start working, you're like, I want to be in the most exciting sectors.
Yeah.
This is where my career goes on from here on out.
Future.
But I think one thing I realized from the investing world as well is that boring is not necessarily bad. I think when you think about a lot of the great businesses out there, they're based on the most basic necessities that you have, be it supermarket businesses. I mean, you think about the Costco's and the likes of the world, those are amazing.
Yeah.
You think about, even air conditioning within buildings, where you think about the HVACs and the likes. Those are nothing exciting, but they're great business models. They're resilient, and there's a plenty of growth opportunities. And so I think I sort of applied that to myself, where the sector itself was not necessarily the most exciting, but the ability to unlock value within it was very creative. There were a lot of levers you can pull. And so ultimately, I sort of made something that was, I guess, boring in a traditional sense, a lot more exciting in my career.
Okay, let's drill down a little bit. So when we talk of infrastructure, how do you or how Hamilton Lane define infrastructure? And what do you focus? Is a core or a value add? Which area, which sector? North America, Europe?
Yeah, no, I think it's a great question. For us, when we look at infrastructure, it's really about defining it in three key pillars. The first one is, of course, looking at the existing asset base. Infrastructure provides an essential service to society, and without the existing asset base to provide it, you're not going to really be able to serve that need. So when we're looking at buying into these assets, it is one that needs to have attractive entry prices. We don't want to be overpaying for it, as does any good investor. But we're also making sure that there's strong barriers to entry that protect these assets. And this can come from the form of maybe CapEx requirements, market or regulatory settings, or maybe even pricing power from the underlying asset owner. And ultimately, when you couple that with contracted cash flows, and that's really all we're looking for within infrastructure, where you have long-term contracts between 10 to 20 years with strong investment-grade counterparties, that you're basically insulating the business from a market risk such as volume or pricing. When you add these two pillars together, we see it as generating a core-like return of maybe a 7 to 9% return. And then, I think to your point on where we're focusing on, at least on the risk spectrum, we like to focus on the core plus and value add segment, where we are really thinking about adding this third vertical in value creation opportunities. And this comes from a myriad of options that we have. The first being how we can enact operational efficiencies, as with any private equity business. So it could be streamlining sales teams, it could be increasing efficiency of the cost structure. And at the same time, as we think about the build out necessary to service AI, energy demand, transportation, environment, and the likes, is then thinking about how can I grow the existing platforms, but in a de-risk way. So we're not taking on development risks. We're making sure that the capex that we put in the ground are in projects that are already secured with counterparties. And so as we think about generating that core plus value add like mix, it's really targeting 12 to 15% return, depending on the amount of value creation opportunities that can be enacted within the underlying businesses.
Now there are market comments talking about overspending AI-related infrastructure, whether it's data center or data center related. So you are in infrastructure investment, you see a lot of deals, a lot of data. How do you see this space? How much do you see quantify that? How much do we need to invest in this space?
Yeah, no, I think it's a great question because when you look at the infrastructure world today, AI and energy demands are a huge driver and tailwind for the sector. Even when you look at our deal flow, right, 70% of that are in these two areas. And there's always been the question that we ask ourselves as to, is this a bubble? Is there too much going into it? But I think fundamentally, when we look in data centers, the thing that is quite clear for us is there's still a strong need for additional compute to come online. When we look at the demands driven by 5G, by migration to the cloud and enterprise use, that is still expected to generate demand in the order of 10 to 15% in compounded annual growth. AI then comes in as really the cherry on top of the cake that takes you from a 10 to 15% annual growth to a 15 to 20% annual growth. So when we look at it from a data center perspective, I'd say that there is good underlying demand from just the other use cases. And AI is really part of the additional value that we can capture going forward. Well, and then, the other element of it is when we look at data centers that have direct exposure to AI, there's also two key segments that we are focused on. One is AI training, and the other being AI inference. For AI training, that's probably the one that we have a bit more concern about over the longer term, because these assets can typically stay further away from your main city centers. The main goal for these assets are to train the language models and the likes. And so while that may be useful for maybe the next 5 to 7 years, there is a higher likelihood of redundancy further down the road, as opposed to a AI inference asset that's sitting directly in close proximity to end users. That, in our view, is a lot more resilient and has less of a redundancy risk case. So I think the long story short is that AI presents both opportunities and threats. It's about being effective in navigating the investment landscape today.
Yeah. You're talking about maybe there's enough chips, but probably not enough power to power the chips. Where's the CapEx spend go into the energy sector, whether it's green energy or solar or nuclear? What do you see the trend?
That's a question that I can go on answering for the next hour,
Right.
if I'm honest with you.
Please.
So I think fundamentally when we think about the backdrop and the amount of power that is needed to service data centers, that's a huge driver,
Yeah.
right? In terms of the new megawatts that need to come online in the future. There's a few ways that we see it playing out in the market. I think one of the first waves was thinking about how renewables can be a big part of the overall grid. So we're seeing a lot of independent power producers in renewables globally, be it in the US, in Europe, in Asia Pacific, and that naturally has its place in providing the electrons to the grid. But I think one of the key issues that you face with renewables is that it's intermittent. You face issues like curtailment. And ultimately, what you need to provide stability in the grid is baseload. As we move away from coal, there then needs to be a key focus on where you can get that baseload. So one area that has become very attractive for us is in the gas space. Gas is a lot cleaner than you get for coal, but it is still a key part of the energy transition. And I think that's what we need to focus on, is that we cannot go from brown to green overnight. The energy transition takes time. And with the limitations that you have with renewables, there needs to be milestones that you put in place before you can go fully green. So gas is a great way to do it. We've seen even economies like Europe, right, where they used to be against gas. It was all about how can I move 100% to renewables. But energy security is also a big topic today. I think they've started to realize that gas has to be part of the energy system, at least in the near future. And so we've actually seen quite a few interesting opportunities come out in the gas space in Europe when we wouldn't have thought it possible, say 10 years ago. And I think the other element as well is that, especially from an infrastructure investor, is that we want to be looking at things within a defined investment window of say 4 to 7 years. We don't want to be taking on technological risks. And so that's why things like green hydrogen and ammonia are elements that are interesting. We think it'll play a big part of the energy transition, but it's probably not economically viable yet. And so we've stayed away. And it's the same thing, I think, with nuclear, right? Nuclear is actually the cleanest energy you get. But I think the few limitations we have, at least from our investment mandate today, is one, the costs are still relatively high. And so you need a lot of government support or maybe time for the technology to evolve. And the other element is also that the construction timelines for nuclear are generally quite long and it can stretch up to 10 years. So when we think about our investment horizon, it's probably something that is not the most optimal that fits in. But I'd say that we are not completely writing it off. I think nuclear will become an increasingly important part of infrastructure investments maybe in the next 5 to 10 years. But we are not in a position to say that we want to take on that risk. We don't need to be at the forefront of that technological advancement. But we want to be very much playing an active part in building out an established technology base.
Let's probably talk about the new infrastructure and the traditional infrastructure. Is there really a clearly defined between this, or the sort of just like we talked about gas, traditionally we think it's old technology, but now it's becoming necessary for the new infrastructure. Is there opportunity in the traditional, talking about old infrastructure like transportation, port, or major capital always chasing the sort of new infrastructure?
I think that's a great question. For us, I think every single vertical in infrastructure has adequate opportunities in the market today. Ultimately, fast forward to 2040, I think McKinsey put something out like 70 trillion of investments are needed across these sectors globally. For transportation, I think what often comes to mind when you mention it is airports, toll roads, ports, and the likes. But we're also seeing opportunities to electrify some of these existing investments. For one, we recently invested into a rail platform in Europe, where it was really to electrify an existing fleet and then to build out the fleet to cater to the both locally and cross-border. And ultimately, this is a really interesting opportunity where you are very much driven by a fundamental need for travel inter-country. You're insulated from, I guess, a bit more GDP-specific risks as you do with international travel. And so this is probably one area that we're focused on. Another area that is more traditional in a sense is utilities. In the US, we recently invested into a business alongside general partner who are water specialists. So they only look at water assets. And they've found that across over 88,000 water utilities in the US, there has been a fundamental undersupply, or rather there's been a fundamental under maintenance of these existing assets, and a lot of them are risking a breach of their regulatory needs. So we invested alongside them to aggregate these assets, to put capex, to put these assets into a regulatory asset base. And even though you're looking at it from a more traditional core-like asset, you're able to generate outsized returns because of this aggregation play. So I think fundamentally, especially by focusing on the mid-market, there are ample opportunities to be flexible, to be creative in the way you access the same existing sectors. So as much as AI, renewables are the hot topic, I'd say that rubbish businesses are interesting.
Yeah.
And so are traditional transport.
Right. Okay. So we touched quite broad about infrastructure sector. Then let's come back to your strategy. Instead of invest directly into a lot of infrastructure, Hamilton Lane strategy is to partner with a lot of the good GPs to invest. What's the advantage of that in terms of access, quality, diversification? Let's talk about that.
Yeah, no, I think put simply, global private infrastructure fund is about diversification, diversification, diversification. And what this means is that we're diversified across general partners, we're diversified across sectors, and we also diversify across geographies. The benefit that we have is that we are able to find the best managers in what they do, right?
Yeah.
Be it country specific, sector specific, and the likes, and ultimately put together a portfolio of best ideas. So, I think when we look at the portfolio today, it is well capitalized by a range of general partners. We have over 200 GP relationships within infrastructure world. Today, we've invested with over 30, and we expect it to continue to grow. But ultimately, they've all shown the ability to deliver consistently across market cycles and across different investment time horizons. So, yeah, I think that's really the key benefit that we're getting out of it. And I think the other benefit that we have is that we are able to filter through basically the deal funnel that's already been filtered, right? When you think about it, as a general partner invest into, let's say, a transportation asset, they would more likely than not have seen 5 or 10 deals before they made that one investment. For us, we are looking at the deals that 10 general partners have done, and we're taking it through the funnel that they've already funneled. And so we think of it as a good way to sense check the market, and at the same time really rely on the data that we have across the vast data set that we have to make the best investment decisions.
So the other questions are looks like all the top tier alternative managers all get involved into private credit, private infrastructure, and private equity. So in your view, what's the synergy among the three sector when all of the three sectors?
Yeah, no, I think for Hamilton Lane, it's always been very clear that private markets have an increasingly large part to play in portfolios. And so when you think about it, our history goes back over 34 years, and we have consistently invested across private equity, private credit, venture, private infrastructure, real estate, and the likes. For us, it's clear. One, when you look at the proportion of businesses that are listed in the public markets, that has consistently dwindled in recent years. And so private markets provide a much wider spectrum of deals to be looking at. And at the same time, it provides a better risk-adjusted returns for portfolios. Generally speaking, when you're putting in private assets, you get superior Sharpe ratios, you get lower volatility. And when we think about it as a long-term horizon, even for private investors, that becomes extremely useful because, as you know, there may be times when family events or unforeseen circumstances occur, and you need to be tapping on your existing asset base. You don't want to be caught out necessarily in a time when asset valuations are low or there's troubles in the economy. And so I think private markets at the same time provides that balance as well, where valuations are typically a lot more stable, and ultimately it gives you a lot more flexibility as well as comfort in terms of where your portfolio is trending over the long term.
Yeah, I understand Hamilton Lane has been managing the semi-liquid evergreen product for long history. In the last several years, more and more semi-liquid evergreen products come to the market. And recently, there are a lot of sort of a negative media coverage, especially in the private credit sector. What's your view about, is there a normal when the asset class growing significantly, or is there a better way to view this or to manage the liquidity, or how do you see the risk? Is there a warning sign in the sector?
Yeah, no, I think it's something that if you think about the way capital flows, it's been consistent cycle after cycle, where if there is some sector that's hot, there's naturally going to be a lot of capital chasing it and plenty of players thinking about the best way they can get their foot through the door. For us, we've been investing in the evergreen space for 7 years now, and we manage over $10 billion within these specific structures. I think what's important for investors to look at is that it's not just about the investments that are being done. When I and all the rest of my team look at deals, we can make our opinion on why this is good. We look at comps in the market, we look at the underlying fundamentals and make an investment decision with the IC as to whether it's one that we want to be putting our capital into. But one area that's probably not so well appreciated is that managing evergreens is a huge task. We have over 40 people that are dedicated to portfolio management and evergreen solutions that track it on a daily basis. They keep us honest in terms of what kind of deal profiles we need to be putting into the portfolios. They make sure that we are keeping to our sector allocations, geographic allocations, making sure that we are able to generate the yield if we are promising a yield in that particular strategy. And ultimately, they make that call as to whether that deal is a good fit for the underlying investor. So for me, it's not just about looking at, especially when looking at evergreens, it's not just looking at how attractive the investments are, but what is really supporting them as part of the backbone. That is one that is incredibly tough to replicate. It's one that we built around for 7-8 years now.
Yeah.
And so that's, for me, is one of the biggest risks because operationally an evergreen is not easy to manage.
Yeah, of course. Let's touch a little bit in private equity sector. I know you found in private equity, you have co-investment, you have sort of secondary market, you have even a small portion of VC. What do you see the value now in this at this moment? Is it in VC or secondary or co-investment, direct private equity?
Yeah, no, that's a great question. I think when you ask any Hamilton Laner, I think that it's a very simple answer that private market is the way to go. I think when you think about it from a private equity lens, and then you break it up into co-investment, secondaries, and the likes, there is fundamentally an important part that each one of these can play. For example, when we look at co-investments, we are really partnering with the best-in-class GPs across the world, be it infrastructure, private equity, buyout, growth, venture, and the likes. And we are providing them with strategic capital to get deals done in a timely basis. At the same time, when we look at the secondaries market, we are then able to provide liquidity to a generally illiquid market.
Yep.
A lot of it is driven by a multitude of reasons, be it insurers that have to adjust their risk capital charge, be it larger pensions that are looking to liquidate their existing investments to meet their financial obligations and the likes. And so for us, being a secondary market allows us to be nimble in providing attractive buying opportunities. So that is on the private equity side of things. And then we think about credit. Well, credit, like what you mentioned earlier, has come under a lot of scrutiny.
Yeah.
But fundamentally, there's still a really strong market for private credit. And it still remains very healthy today. When we look at the underlying balance sheets of the companies that our firm is supporting, those continue to remain robust. When we're looking at the capital stack and how we're playing it and structuring of the underlying investments, 98% of what we're investing today is cash pay, and only a small proportion is PIK.
Yep.
So we are getting a good proportion of our investment basis back year on year. And that then again becomes a really interesting opportunity for private investors, right, to get their hands on yielding investments that are stable with high quality businesses. And while yes, there is some exposure to AI, it's not the predominant exposure that we have. And so it builds a well-rounded portfolio of both equities as well as credit. And then when we think about venture also provides a lot of opportunities. And I think that's really down to the point where a lot of these growthy businesses are no longer listed,
Yep.
right? And being part of the venture world allows us to come in early to support strong management teams and strong theses and really capitalize on their growth. I think when we look at some of the businesses that we invested in, There are some that we've come in at the angel round. There's some that have come in at Series B, Series C. And it's really about giving us that flexibility to tap on that next frontier of growth at the appropriate time. So I see it less so about whether one element of the private market is more attractive to an investor or not, but more about how you can take everything collectively to form a well-rounded portfolio.
So my last question is about what lesson can we take from institutional investors? Because Hamilton Lane, until now, you still advise a lot of institutions for their general asset allocation in private market. What's the institution client they're doing? Allocate the capital. What's the proper reasonable sort of percentage they invest or compared to private investor? What private investor need to catch up?
I think when we look at the private market allocation, that's always been a big part of institutional investing. You can point to multiple endowment models and the likes in terms of how that was taken up over the years. For me, I think the key thing to take away is that having a well-rounded portfolio is not just about exposure. It's not just about being invested. I think we always talk about protecting our assets and having to be invested. And that traditionally has come through a stock and bond portfolio. But today, alternatives are a big part of it as well. I think how institutional investors are generally have a better temperament for the markets is that they're typically less reactive. And so I think private markets does help solve some of it, right? Because when you think about the public markets, sentiment changes from day to day. You can see your portfolio up 10% one day, down 10% the next, and it could be based just on market noise and nothing that's fundamentally affecting the business. Whereas when we look at how private market assets are valued, these are based off comps. They're based off valuers with third-party validation. And so I think having that as part of portfolios gives you calmness when you're looking at movements in the portfolio. You are likely to be a lot less anxious, less reactive in terms of trading these assets. That really helps you to see that, well, when you stay invested for longer, you generally do better. And so you're less reactive, you stay invested longer, ultimately you enjoy the compounding returns.
Yeah, exactly. Again, thanks again for taking your time during Chinese New Year to leave your family, come to Australia to support us. We look forward to the next catch up.
Thank you. Thank you for having us.
元宵节快乐！